A common way for business to earn equity financing and raise capital is by selling stock in the business. Now, how can this be done? Firstly, is through initial public offering, or we can refer to as IPO. Now, what is an IPO? An IPO is an example of primary market operation. It is the first sale of stock by a private company to the public. This act of selling stock is by listing on stock exchange, which in Malaysia is solely regulated and operated by Bursa Malaysia Berhad. Now, say that the investor that bought the stock that was issued by a company is in need of cash, and the company refused to sell the stock back to the business. Now, how do they earn the money back? Now, that's when the secondary market comes into picture. This is secondary investors. Investor. It is when the investors, both investors, participate to buy and sell existing financial security. This new investor, buy and sell. Another way of earning equity financing for companies is by selling both common stocks and preferred stocks. Common stocks and preferred stocks are both publicly traded at the stock market, and when investors are investing, they are investing in the underlying companies, and both investment entitle the investors to claim in the company's assets and profits. The differences in this are in terms of risk and return potential. Investment in common stocks has higher risk because the investment returns mostly comes from capital gains rather than dividends. And in contrast, investment in preferred stocks have low risk because the investment returns mainly come from dividends as opposed to capital gains.
Hello everyone. Okay, today I will tell you about return earning. For your information, returns mean to keep and earning mean profit. Return earning commonly defined as a part of the company's cumulative historical that has not distributed to the shareholder through the dividend.
Yeah.
Okay, return earning is the one of item that connect the income statement and balance sheet. To start income statement is at the start of every new year, but to close the year and make the balance sheet balance is at the very end of the year. So, how to make the balance sheet balance? We must to add profit that we made to shareholders' equity. But I have a question. What is the return earning on the credit? On the credit or right hand side of the balance sheet? Two ways to think about it. First, you owe the return earning to the shareholder, and the right hand side of the balance sheet is overview of what a company owes. Two, if you are profitable as a company, you grow the asset left hand side as asset quicker than the liability, which is at the right hand side of the balance sheet. Therefore, you need to plug an amount in equity to make the balance sheet balance. So that's for me. Thank you.
Annyeong. Assalamualaikum. So today I would like to talk about venture capital and private placement. Okay. So what is venture capital? Venture capital is the finance that investors provide to start up companies and small business that are believed to have long-term growth potential. Okay. So venture capital generally comes from wealthy family or joint venture formed by corporations and pool of investors. Okay. So in return for financing, these investors generally receive an equity or ownership position in the business and share in its profit. On the other side, private placement means that when stock and other corporate securities are sold directly to insurance companies, pension funds, or large institutional investors.